Welcome, welcome, welcome. If you are just now watching the recording of these, I know a lot of you have become a little bit good at going to the Orange County Realtors site and watching on the library, so you don't have to take a 10 o'clock period out of your day to watch these as well. So the library of watching and the Facebook Live watching audience seems to be growing exponentially. But if you're here live, we appreciate you being here. And if you're watching the recording, we appreciate you watching the recording. You just don't get to ask questions because if you do, we won't answer them. My name is Dan Smith. Thank you for being here today. We have a really cool guest. He actually spoke at one of my events, 3-4 years ago now. It's been a while since I first met Jordan. And so he is now the big dog at California Association of Realtors, all things economic forecasting and economists. Filled some very big shoes there and has done a fantastic job doing it. And so we're gonna do an interview today. So rather than like share a PowerPoint, like you probably do a lot of econ forecasts with different people, instead of share a PowerPoint and him talk about that, we're just gonna like fully do an interview about the state of the market, specifically here in California, not on a national level so much. All things, we're still in the Zoom world, everybody. So if I freeze, I'll be back. If Jordan freezes, he'll be back. And if you have questions, use the chat bar or the Q&A. I don't see, there it is. Q&A is better for questions. Sometimes you guys put it in the chat though, so I'll be monitoring both. If you're watching on Facebook Live and you're not watching the recording, go ahead and throw it in there. Someone's monitoring that. We'll get those questions answered for you as well. So with that, let's kick it off. Jordan, tell everybody what your official title is other than big dog of econ. And we'll go from there.
Yeah, sure. I like that one better though, I gotta say, but no, I'm the chief economist at CAR. I also am a vice president, which just means I sit on all the kind of business meeting stuff as well in terms of what we do as an organization. But I like to say I'm the kind of data nerd in residence at CAR. So looking at the economy, looking at all the market data, producing the reports and stuff that our realtors use to have those conversations with their clients, to educate themselves, what have you. So no, a lot of fun. My dad was a realtor, so it's a very fulfilling job as well.
And you, like a lot of our agents, look like you are still working out of a home space. So you guys are not currently back in CAR HQ yet, especially we're in Orange County. So we have our little OC protective bubble here, but
right.
CAR's LA, right? So
yeah, exactly.
Full bubbleless. So
back to the bubble. Yep. And things are just continuing to evolve at a rapid pace, like by the day, by the hour, it seems. So yeah, we're still riding that storm for sure.
All right. So everybody who's watching, again, type the questions in fast and furious, because I'm only going to have so many. This is a great opportunity. You don't often get to talk to an economist like one-on-one and get your actual individual pointed question answered. Maybe he won't have data on that. Maybe he won't know. But this is definitely your shot to get it asked. So let's start with where we thought we were going maybe a month ago, and what's been going on in the world of California real estate January through June.
Sure.
What has that looked like for all of it? Because here's the thing. Agents have a perspective of what's happening in the market based on how many escrows they have.
Right.
And if they're busy, then the market's good. And if they're not busy, the market must really suck. But maybe they weren't paying attention that other people were busy. So what have we been seeing?
Yeah, I think, I always hesitate to use terms like good and bad just because beauty is in the eye of the beholder, obviously. And so whether you already own property, whether you're a buyer or seller, what have you, it kind of matters from that standpoint. But from a kind of macro 30,000 foot level, the market's been doing well, right? We came into 2021 with a lot of momentum, surprisingly, even with all the kind of problems that we had economically in 2020, the kind of nature of those problems made housing do, even better than ever, right? We have this kind of renewed value of home ownership, it seems like, where folks, our homes are more important to us now than ever before. We had a lot of first-time buyers go into the market last year, and that's continued to kind of show itself in rising home sales this year. So we've been growing on a kind of double-digit basis for the entirety of the year almost, right? And part of that is because last year we pressed pause on the spring home buying season back in March, April, May. But, once we started coming back in June, July, August, the numbers actually were getting to like 15-year highs. We actually ended with more than 500,000 home sales on an annualized pace at the end of last year. And so, part of it is just real honest to goodness momentum in terms of more transactions. So I think from that standpoint, the market is doing well. People want home ownership, and we see the number of home sales actually going up. So
you mentioned right when we were getting on that you're so glad you guys are doing weekly reporting now instead of monthly. And so I'm really curious because for me, it feels like this has almost become a normal year.
You're right.
And now normal in terms of its growth, but from a cyclical standpoint, I felt like we cranked in spring. Spring market was the traditional like lights out, balls to the walls spring.
Yeah.
And then I feel like we hit June like we normally do, and it started to taper. And then I feel like we hit July and people could still vacation in August, and it did slow some. And then realtors freaked out because it was slowing. But that's called June and July and August.
Sure.
But are you guys seeing that in your weekly numbers too? What are you seeing?
Yeah, it's funny. I actually, right before I jumped on this call, I was doing an interview with the Sacramento Bee, and they basically asked this, same question, which is, how much of this is seasonality? Because the July price wasn't a new all-time high for the first time in a couple of months, according to somebody's report. We haven't put out our July number yet, but I do think that, last year there was no seasonality. We pressed pause when the home buying season should have been ramping up, and then all of a sudden, when home sales are normally dying down, June, July, August, right up through December, sales were surging, right? And so that normal seasonal pattern was kind of non-existent last year. Again, we had all these structural issues that forced people into the market. They're like, I don't care if it's November, I can't continue to have competing Zoom meetings with my partner in this 1-bedroom condo, like get me into that 3-bedroom house with the backyard. But I think you're right that in 2021, we saw that reassert itself a little bit, right? That we did have home sales really start to crank in March and April, and we were growing by, 30, 40, 50% in some cases from where we were at that time last year. There is kind of also an underlying economic component to it as well, though, because I think, there's also the kind of fear of inflation that drove rates higher, earlier in the summer, and people kind of freaked out, and we saw some buyer fatigue start to set in those mortgage applications. So I think part of it is the just normal seasonal aspect. And I think, part of it is that we've had an imbalanced market for such a long time that it's having its impacts on both kind of supply and demand to a little extent. For me, it's kind of good news because it means those student loans I've been paying forever have been worth it. Like markets actually work, right? When you have an imbalance for so long, then the market starts to work itself back towards balance. So I hear what you're saying, that is a cause for concern, but I don't think it's one for panic. I think it just means that, that supply is starting to come back around and demand is normalizing itself after just such a crazy period.
What are you guys, and we've got some questions coming up. I want to ask one more,
Awesome.
Then we'll get
Great.
into it. What are you guys forecasting for, and I don't know that you can be this specific, for year over year? So either this June to next June, or this May to last May. I don't know how current you guys keep those numbers.
Yeah.
There's a lot of talk going on out there like, hey, if the market's going to go up 10% on $1 million house, that means this year's million is 1.1 next year. That's a great marketing tool for real estate agents, right? Saying, hey, who would like to make an extra $100,000 in the next year? Just buy a house.
Absolutely.
So I'm just curious what you're forecasting is that, because we see all the percentages from different people, and Keeping Current Matters always posts stuff. What's the CAR forecasting for a year's growth?
Yeah, so we're forecasting that this year prices are going to be up by about 20% on an annual basis from where they were in 2020. So, we're already growing in excess of that. So we actually expect price growth to cool a little bit during the second half of the year. There's going to be a little bit more supply. Rates are a little bit higher than they were when they were 2.6%, what have you. So, we're going to end probably close to 800,000. Next year, we see the market kind of, again, hoping that that normalization continues to play itself out. And so we measure median price. We're not the Case-Shiller index. So we're looking at median prices, and we're heavily influenced by the mix of units being sold. So with that, we have the market shifting back from the kind of 3 million plus, which has just been absolutely head and shoulders above the rest of the market for pretty much the past year and a half straight. Going back, hopefully, towards the owner occupant side of the market. We do think some investors are going to get out of their rental properties when the eviction moratoriums and things like that are up. And so that's going to mute the price growth. So we have prices going up next year, but probably by single digits after a 20% growth year in 2021.
Okay, good. So,
but in Orange County, I think Orange County's median price is like 1.14 was our most recent measure. So, single digits on that is again, like you said, still a pretty significant chunk of money.
Yeah, that's a good, it's still 90,000 on a million, right?
That's
if it's
right.
9, it's still 50,000 if it's 5. So
that's right.
All those numbers equal a lot.
That's real money. Yeah.
That's real money.
Yeah.
All right. So a couple questions. You may or may not know some of this. What percentage of current real estate sales are above asking price? What's the latest surveys saying?
Yeah, so we actually track this off all the MLSs. We keep track of what the list price was and then what the closed price was. And I think last month it was a new record at just over 71%. I think it was like 71 point something, 71 and change, which means, it's almost 3 out of every 4 transactions closed above the asking price. And actually, if you look at just the median sales to list price ratio, that's how high, sales prices relative to list price. I think that was also an all-time high last month, and it was like 104.4%, which means that 50% of the transactions closed at least 4.4% above ask, but 71% closed somewhere north of ask, whether it was 4.4% or less, but more than what was being asked. So just, again, incredible numbers. And actually you see it in time on market too, which is just kind of the flip side of that same coin, right? When there's not enough homes to buy, they sell for more, right? Because it goes to the highest bidder, but they're also going pending in 8 days statewide, which is just an incredible number. The time it takes for it to hit the MLS and go pending, again, on median. That means that 50% of the homes that closed last month went pending in less than 8 days. And so, it's just a real ferociously competitive market. And even with this kind of, that's why, I say don't worry too much about the kind of normalizing of the market where demand is a little bit softer. We do have a little bit more listings. So you're not going to see that same ferocity in price growth, I think, and same kind of over list price, many offers on one property, but you're still going to see most of that, right? A lot of it's still going to go on because we still got a long way to go on listings relative to how many people just still want to buy homes.
And it's interesting too, because I feel like I say this all the time. We're living in the greatest real estate boon of all time if you're a real estate agent. But at the same point, it is the hardest real estate market to work in if you're a real estate agent, because you can write 13 offers and get 0 accepted. It'd be so great to not be in the greatest real estate market of all time and just be in a good market, but get half of your offers accepted instead of 5% of your offers accepted, right?
Yeah.
There's that weird catch-22 there. You want the market to be good, but not too good now.
Right, exactly. And, that's kind of where I love where I'm at in my job right now, because, there is a bit of a shift. And I think it is time for real estate professionals to kind of freshen up that script, because it always pains me when you see those kind of buyer fatigue numbers. And we do monthly surveys of just California consumers. Is it a good time to buy? Is it a good time to sell? And people are saying, no, it's not a good time to buy, or that those numbers continue to dwindle, right? And it's a shame. And it's, I think, a function of what you said, that people are out there, they look at 15 homes, they put in all these offers, somebody else puts in more money, they're willing to waive all these contingencies, et cetera, that kind of eats into your psyche. And yet, home prices are up 30% this year from where they were at this time last year, right? And so for those folks who persisted, right, and said, show me the 15th house, show me the 16th house, right? And so I think we can manage expectations both by, really kind of highlighting those benefits of home ownership. Like you said, a lot of people have made a lot of money over the last 12 to 18 months, and projections are for prices to continue to go up. But at the same time, you have slightly more options now as a buyer, right? There is a little bit more inventory to choose from, which means that, pound for pound, there won't be quite as much pressure, I think, as agents on the sell side. We also have to be realistic with sellers who have been in a kind of, in the driver's seat, as it were, for a long time, that there is other homes out there for buyers to choose from. And maybe we can't be more, as aggressive as we have been over the past 12 months. And I think that is, those are all opportunities for us as individual realtors. Like you said, the market overall is doing good, but for us to be able to capitalize on kind of what's happening right now is, reinvigorate those buyers. They might now have a chance with these extra listings coming out. So
what about cash? How big a role has cash played in the market?
Cash is important, but it isn't necessarily all cash. So what we've seen is that people are coming in with big down payments, right? And that is definitely the case, but it isn't necessarily the all cash investor. In fact, when you look at the composition of demand, a lot of it is first time repeat buyers on either primary residences or vacation homes. And so, with interest rates as low as they are, I think, it kind of makes sense from that standpoint that, yeah, you're seeing folks put down big chunks in terms of down payment, but it also makes sense to use the bank's money in this kind of environment as well. And so I think that you have folks putting down enough cash and down payment, what have you, to make sure that they're, to secure the property, right? To make sure that theirs is the most attractive offer, but not necessarily, throwing all their cash into the unit if they don't have to. Again, at 2.78%, you can make better use of your own capital. And so I think that it's just kind of, for those who have cash, you're able to use that as a tactic to make sure that yours is kind of the juiciest offer. And that's kind of the bigger dynamic that's happening out there. And I think why many of those first-time home buyers, or folks who are just right on that kind of margin in terms of being able to afford, are getting out competed. It isn't necessarily the all cash investor. It's just folks who have been long-term renters at very high incomes, who maybe don't have to go into the city anymore, right? Or they do have that need for additional space or what have you, or they have like boomer parents who are able to take out a HELOC and help them with the down payment, or all of the above in some cases, but not necessarily 100% cash.
All right. I think we might have answered Linda's question as we were talking. She wanted to know if we thought prices, Linda, let me point out whatever I think is flip a coin. Jordan's got some actual stats, so his is a little bit better, a lot better, enormously better than my ideas. But he did say, single digit growth is probably what we're looking at over the next year. So not going down, but single digit growth.
And that's for the median.
For the median. Do you guys do anything forecasting? And I just don't know. I don't understand the world of econ real well. Do you guys do any forecasting longer than a year out? Do you guys do 2-year forecasts?
Yeah, we do like 3 and 5 year forecasts for our strategic planning purposes. And we see the market more normalizing. I mean, absent a big shock, the forecast calls for it kind of reverting to the norm, as it were. And I think that kind of plays into Albert's question as well about rates, is that we see rates kind of normalizing over the medium term as well. We think they're still going to be pretty favorable for housing, I guess would be the right way to characterize it this year. And actually, we just downgraded our rate forecast a little bit when you look at the kind of COVID numbers and the lockdown reasserting itself and these mandates going back in and things like that. We think, that's probably going to stay the Fed's hand a little bit in terms of being more aggressive on this inflation, which we still think is largely transitory, and we can get into all that if folks want. But I think that the moral of the story is we have rates that won't go up as fast as maybe we originally thought. When you think about rates over the medium term, I see rates kind of going back to a kind of pre-COVID type of level. I'm not in the camp where there's going to be all this breakaway inflation that's going to structurally increased the rates on 10-year bonds and things like that. But I do think, even without this big bout of inflation, in a kind of normal market like we were in 2019 or even before, you could see 10-year bonds going into the kind of 1.8 to 2% range over the kind of long term. And if you look at where spreads normally are, right, where mortgage rates are relative to 10-year treasuries, that you see those in the kind of 160, 170 basis point kind of range, right? So if you add all that up, I think it means that you're at a kind of steady state mortgage rate eventually, once we're in a kind of recovered economy a couple of years down the line, that's in the kind of 4.5% range, even without a lot of inflation. So I do think that that's something that we're going to have to grapple with, because even though, and I'm the son of a guy who used to walk around bragging about his 12.5% mortgage rate back in the 80s all the time. So 4.5% is still like an incredibly low interest rate by historical standards, but prices are so high now too, that even little changes in rates, right? We're at 2.77, I think was Freddie Mac's rate last week. So going from 2.77 to 4.5 over 3 years or so is still a hit to the pocketbook at $1.14, million median prices. And so, we will see a more balanced market, I think, that will take us away from that, kind of 510,000 unit pace that we were at the end of last year gradually as well. So we're kind of middle of the road. We're not really alarmists on interest rates, but the reality is that those are going to have outsized impacts when it comes to how much people can afford on a monthly basis too.
All right. Another question here. It looks like literally of 1,000 zooms in, I feel like now. This is maybe one of the most technical questions I've seen. I'll ask it because I'm not sure that everybody else can see it. I know you can probably see it, Jordan. JP Morgan Q3 guide to markets reflects a 96% bump in the S&P 500 index. What would be the best number to look at when comparing this to real estate?
Yeah, the equity markets have been on fire. The equity markets have almost doubled, I think, is how I would interpret that one. Since the onset of COVID. And I think it reflects the kind of structural nature of this crisis, right? Where there was a real, not all industries were created equal, I guess. We'll use the animal farm reference, right? But there was, if you worked in a remotable industry, right, in California in particular, right, the kind of the 4 highest paying sectors lost less than 10% of the jobs. So we lost about 2.7 million jobs in California last year, and only about 10% of those were in in our 4 highest paying industries. So some folks are doing better than ever. The companies that make goods and services that help us do things remotely, right? The Zooms of the world, the GoTo meetings, the Amazons, right? Those numbers increased overnight significantly. And that was, much bigger than the increase even in housing. The relevant number, I think, to compare that to would be like a S&P Case-Shiller index, or, like our price per square foot number for California statewide, which shows still, double-digit growth. Like, on a per square foot basis, I think prices are still up 30% or so on a year-to-year basis here in California, but that's still not, a doubling the way that you see in the equity markets. And I think it's just a reflection of, and also an explanation for, why housing is doing so well, right? It's a reflection of the fact that high income earners were relatively insulated by this crisis, and in some cases are doing even better than ever financially, coupled with that, fact that our homes are more important to us than ever before. And these are like the same folks who own stocks, right? So
doubled.
Right. So when the market doubles, not only did their company do well, they got a raise, they're still employed, their actual wealth went up as well. And they said, let's buy that cabin in Tahoe, right? We're going to buy that cabin in Big Bear, what have you, or we're going to move to Laguna Beach, right? And get out of this condo because I don't have to drive into Irvine every day. And I think you saw all of the above last year, and it's continuing on into this year.
All right. Albert asked a second question. What's your opinion on why units And Albert, I just don't know if you type in a word real quick while I finish the sentence. Do you mean like rental units, like apartment units, like condo units, or just units in general, SFRs and everything? But the question was, what's your opinion on why units are coming back on the market? Could be that the price is slightly overrated.
Possibly. I think it's also some pent up supply, or yeah, I think it's some pent up supply as well, right? I think part of it is the market mechanism, right? That when you see your neighbor's house go pending in 8 days and sell for 4.5% more than what your neighbor was asking for it, that is an incentive for you to get your property on the market. I think there's also just folks who maybe would have wanted to sell over the past year and a half, and because of COVID, because we couldn't do open houses, because there was all these PED forms, maybe you just didn't want people coming in and out of your house, right? You didn't want to deal with it, that you kind of camped out on your house for the last year and a half, that now you got your shot or whatever, you feel comfortable. So there's kind of that element to it as well, right? That we're seeing, I think a little bit of both, that market mechanism does work. And again, those student loans weren't all for naught, but also that kind of people wanted to move, right? And there's life events happening out there that are independent of COVID. Before this crisis, the way that we used to forecast was really looking at life events. How many people are getting married? How many people are having kids, right? Like the demographic changes. How many people are getting new jobs? How many people are getting promoted? What's happening with incomes? Can they afford more? And all of that stuff was still going on, right? They were getting married, they were getting divorced, babies were happening, they were getting jobs, they were losing jobs. And so I think that stuff is all playing itself out now in a more normal way, because we or at least up until the last couple of weeks, we weren't in lockdown anymore.
You probably have a little bit better handle on the rumor mill than we do about the whole work from home / work from office / work from home hybrid models.
Yeah.
How is that potential migration to different cities, to out of state?
Yeah.
People coming to California, because how's that potential migration affecting things?
Yeah, I think it's a great question. And I think we don't, the true answer is we don't fully know. And I think it's still playing itself out across, boardrooms and conference rooms across the state right now, right? That folks are looking at a lot of folks are locked into long-term leases, so they haven't had to make that decision yet, right? About what's the future of office and work from home and things like that. But I think when you look at workers, especially if you're in one of those high wage remotable industries, are kind of voting with their feet, right? That we did see some folks move out of the cities, right? And get those cabins in Big Bear and Tahoe and move to the Inland Empire and get a big old 3,000 square foot house in Corona or something like that. And I think that part of that will be permanent. I think the question is one of what percentage, right? Because I think we're talking about a percentage. People will go back to the office. There's collaboration, there's, stuff that requires face-to-face interaction. So we will go back to the office. The question is, what percentage of workers for what percent of the time? And I think that, we look at about 30 or 40% of the workers as being truly remotable in terms of their jobs, and will likely work from home, a couple of days a week at least moving forward, right? And that equates to about 10 or 12% or so of the kind of worker hour time, right, that people spend working, being done remotely in the grand scheme of the economy. And I think that will continue to influence the kind of what and the where in terms of housing demand, right? That you might see more people move a little bit farther away from the place where all the jobs have traditionally been. But what we also see pretty consistently is that there's still a lot of folks putting down roots in the cities. If you look at the areas that are growing fastest in California right now, it's in the Bay Area, LA, and Orange County in terms of home sales, right? And again, most of these are buying primary residences or second homes. So yes, there is some folks who are taking advantage of the opportunity, and not having to drive to the office every day. But the other thing, especially as kind of the public health side of this fades, is people want culture too. People want to go out to restaurants. They want to go to a ball game. They want to do a lot of the stuff that traditionally has brought people to cities in the first place. I can't, I live on the Central Coast, and unfortunately you can't just, go out and see like Hamilton or something like that right down the road. I got to go down to LA to do stuff like that. And so I think that, that can also be overblown. We actually survey our members and say, where did your seller go to? And we still see, about 2/3 of realtors that we talk to say that their seller, stayed either in the same city or in the same county that they already lived, or just moved to a different part of California. So,
all right.
We haven't given up on the cities yet.
Somebody asked, you mentioned it, and so I think they just wanted to hear it again. What is the growth number for per square foot? Was it double?
Per square foot prices haven't doubled. I don't remember the percentage off the top of my head, but I know per square foot, California was right around $300 last year. And I think they're closer to 400, like 390, 391 in June, which would put it about 20 to 25% ish, somewhere in there, which is less than the overall median price, right? Because it's not being dragged up by all the $5 million homes that are being sold, but it's still showing pretty significant growth year over year.
All right. If you guys have other questions, keep them coming. We've got everybody's answered so far, so I've got a couple of my own stacked up. But but if you guys have them, throw them back in there, and I will. I've got one. I got 5 or 6 of my own stacked up too. We'll start with Linda's though, because she just threw one in. Everybody else, feel free. Most of the people from LA are moving to OC. Oh, seems like a lot of people are leaving LA and coming to OC because there's a huge homeless issue in LA, and still only a relatively minor homeless issue, it appears, at least it feels, to people in Orange County. What do you think about that? Do you see a lot of migration as a result of that? Do you survey that?
We haven't surveyed on homelessness specifically being a cause for migration, but I do know that the homeless situation in LA in particular has been just absolutely devastating, in part exacerbated by this crisis, no doubt. A lot of the folks who weren't in those high income earning remotable categories, right? Like service sector jobs have now been added to the homeless rolls, right? And so this is an area where the economy disproportionately affected those who were most vulnerable for this kind of stuff. And for me, I think it really just kind of highlights how severe the structural issues were before this crisis even, right? Like, to me, this is a symptom of a much deeper cause that's been a much longer time in the making. And it's, something that we've been kind of harping on for decades about not building enough, about how it impacts housing, home ownership, right? Because people can't afford to buy homes enough, right? That we don't get enough people into home ownership because we don't build enough to keep prices from growing so crazy out of sync with incomes. But that, affects the rental side of the market as well. It affects the poverty side of the market, right? When people can't become homeowners, even those long time, renters with high incomes, that some of which moved into the market last year, you have a lot of people making 6-figure incomes who should be homeowners that are staying renters. Well, guess what that does to the rental stock? It drives up rents, right? Because you have all these high income earners there competing over a limited supply of rental. So it pushes up the rents, it pushes down the vacancies on the rentals. And then so the middle class, has to compete with higher rents, and they bid up the cost of these lower end units. So it means more people can't afford housing. And then you have a crisis that you throw into that kind of an environment, right? And all those people who are right on the bubble because of this whole chain of negative impacts on affordability, which all stem from, again, having grown from 25 million people in California to 40 million people, and seeing our, rate of residential construction drop by, 66%. You don't have to look much farther than that, but these are the consequences of it, right? And then when you have a big crisis, you have a lot of people who have to shack back up. You have poverty go up, you have homelessness skyrocket, and then you have all of the kind of downstream consequences that Linda mentioned, in her question, amongst others, right? That there's just a lot of pain and financial distress. And, the saddest part is that we, this was all within our ability to address and to mitigate, if not eliminate, right? So
yeah, I heard somebody recently talk about, and again, is more of is an NAR person talking about multi-generational households.
Mm-hmm.
and how they saw a real big increase during the pandemic of multi-generational purchases.
Sure.
What are we seeing in California with that?
Yeah, big increase in multi-generational. I think there's a lot of that's one of the motivations for a lot of this ADU stuff, right? Is that folks want to be able to have, in-laws come and live with them, or grandparents want to be closer to kids and whatever, but want their own space so that we're not at each other's throats and all of that. But I think, it's not just the multi-generational, although I do think that, we have an aging population base, right? That will continue to drive that kind of stuff, just because folks will need a lot of care moving forward as we become a kind of more top heavy population. But also, I think that's a reflection in some cases of the affordability situation, right? In some cases, it makes more financial sense, right, to build an ADU in your kid's backyard than it does for you to kind of go out and buy your own $1 million property, right? And we actually see that we actually have a much higher share of what would be considered overcrowded households even than what you see in the rest of the United States. And I think, that part is affordability driven. And so unfortunately, if you look at the kind of root causes and our what we're doing to address them, I project that will only increase, right? Because those numbers are going to keep getting worse.
Two things. I'm going to go back to rent, but actually I want to stay on this then. So at the beginning of COVID, as all these office spaces were turning into ghost towns, there was a rumor mill going around that, wow, what if we were able to turn that tower into the 1,000 units?
Yeah.
What if we were to be able to turn those 10 empty towers into 10,000 units that we just see sitting there that it may never be occupied again? Does that rumor mill still seem like it's based in reality, or is that like a pipe dream of people who wanted to try to fix this problem? Or is it something that we think we might still see coming down the pipe?
Depends. I think that there's an opportunity there. On office, not so much. I think that office, if you look at like CMBS delinquencies and things like that, the office market has held up much better. Now, whether that's because folks are still locked into 5-year leases that they couldn't get out of, and that the shoe is waiting to drop, so to speak, on office. But I tend to think not, right? That people haven't made real drastic cutbacks on office. But if you look at the retail side, those numbers have not come back as quickly, even as the economy has started to open up, right? We see hotels, which were hit much harder and have a lot more room to make up in terms of, lost ground or what have you, but are growing much quicker, right? The uptrend on hotel and restaurant is much stronger than kind of Main Street retail. And so I think the strip mall, even the big mall, right? Like could potentially, look, we've gotten comfortable, buying stuff on our couch in sweatpants. And I think that part is, a big chunk of that will be permanent. And I think that will affect retail, and to a lesser extent, maybe even the kind of, boutique type hotel, or like the Class D hotel types, right? That present a big opportunity. And even if you could peel off a small percentage of kind of strip malls and old school motels and what have you into residential units, it actually translates into a lot of construction. We did some back of the napkin stuff and looked at just, again, even small percentages based on like 10% of the workforce being, remote and 20 or so, 15% of spending happening online, that you can get up into the hundreds of thousands of units pretty quickly doing those kinds of calculations.
Wow, it'd be interesting if we can make that happen, actually.
If the government gets involved, I think that's what it's going to take, because there is a pretty significant gap between what you can charge on a commercial property, like a retail strip mall versus like the per square foot rent you're going to get as a residential unit. But, we could subsidize that. And I think eventually it'll come down to, a smaller dollar per square foot, but with not 100% vacancy will be, the choice that you'll be facing.
All right. Prashant asked a question about condos. Are condos getting hotter this year, especially the lower price ones?
Yeah.
There's affordability. Are there any stats in California supporting condos being hotter other than his gut feel?
Nope. Yeah, dude. Prashant is like a human data sniffer. It seems like, because this is something that I put in a recent presentation that kind of also corroborates the not giving up on the cities part of my comments, right? Because just as the kind of cities were hit hardest initially, sales stopped almost overnight. They cracked down harder on the pandemic and all of that stuff. Some folks moved to Big Bear. The cities have started to come back. And so it's LA, OC, San Francisco, Bay Area that's growing the fastest, but same kind of story, I think, could be, or the same lens could be used to look at the condo market, because condos, when the single family market was falling by 30 and 40%, the condo market was falling by 50 and 60%, right? It was hit much harder. Those tend to be the units that are concentrated in these cities where all the jobs were located, right? And so, but if you look at what's growing fastest now, home sales for single family are up by 30, right? And you see condo sales growing by 35, 40, 50% over the course of the last couple of months. And so I think it's all of a piece, right? Where there was kind of some over the short run, some opportunism, right? Folks with remotable jobs who knew they would never have to go back, took advantage of the low rates and the flexibility to go get more space and move to wherever they wanted to move. But now the market is, again, returning back to something that looked more kind of normal pre-crisis, both in terms of what folks are buying, and the per square foot stuff is also starting to come down, which went up by about 150 square feet almost overnight, which I think is that same story, right? Same city story, same condo story. The square footage story tells almost the same thing. And now, after that initial surge of opportunism, that the market's kind of going back to normal.
All right. So I want to go back to rents. Do you guys keep stats on rents? Does the CIR follow rental rolls?
We track rents, but we get them from external sources.
So, we talked a little bit about what prices have done. If somebody asked again, maybe they came in late, median prices forecast, single digits. It's been 20%, Jordan said, over the last year. They're forecasting for the next year to be maybe single digits, to back down just a little bit. But what about rents? Do we know how crazy they've gone? Because I talked to somebody yesterday that they've written their 4th lease application as an agent, writing it for a client. The lease amount listed was $3,200. They offered $3,750. So it's $550 more than the lease on their application. And they didn't even get talked to.
Right.
They weren't even in the game of the higher ones. So it's almost like the offer market, right? So what are you seeing there?
Yeah, it's crazy. And actually the rental side has come back with a vengeance as well. Even in places like San Francisco, where rents were absolutely decimated during the crisis, we've seen rents bottom out and actually start to go back up again. They're still down from where they were, 12 months ago in San Francisco in particular, but rents have started to rebound. And again, not to kind of be the broken record, but this is really a symptom of just a lack of housing, right? That we have all of this economic growth, we have all this population growth, the economy has started to come back. You've got folks who are finally moving out of mom's basement again, right? And they finally gotten those jobs and things like that, but there's just simply not enough housing. And as tight as vacancy rates are on the ownership side and as low as turnover is, vacancy rates on the rental side are even lower, right? I think we have the second or third worst vacancy rate in the nation on the rental side of the equation. And so again, when you're churning out all these 6-figure income earners and there's not enough homes for them to go out and rent, then they end up writing crazy offers on what is available for rent. You get these big long lines to rent them, right? And you see all those kind of crazy videos on TikTok, right? Where people are lined up around the block with all their masks on, trying to get into an apartment so they can be the one to kind of gobble it up.
So first-time home buyers, you mentioned them a little bit ago. They made up a big portion of this last surge of offers, right? Did I hear that correctly? That was first-time home buyers made up a big portion. And so I was listening to Squawk Box it's probably been a month and a half now back. And Spencer Raskoff, one of the founders of Zillow, was on. Super smart guy, maybe not an economist though. But he had this theory that the first-time home buyers were at risk of getting priced out of the market because there was no transfer in wealth. Meaning, like Prashant said, if you're in a condo, it's only $400,000, and you want to buy a house that's $800,000, but all of a sudden the market jumps and that house goes up 20%. Well, your condo went up 20% too, more than likely. That at least stayed somewhat in line. So you got to transfer the wealth from one to the next. Whereas people who aren't in the game, they don't get to take that wealth transfer. So all of a sudden, 1 year to next, 800 goes to $1 million. How do they make up that deficit? What are you guys seeing, forecasting, afraid of with that?
Oh yeah, no, that's a huge concern. And again, it's all about, beauty being in the eye of the beholder, because if you got your foot on that property ladder, then you just kind of ride that wave. But affordability has taken it on the chin, right? That is the flip side of 30% price growth, right? Is that people fall farther and farther behind the 8 ball from an affordability standpoint. Is that, all of these amazing benefits of home ownership, namely, the accumulation of wealth and building up of home equity, not as many people are going to be able to take advantage of, because the incomes just simply aren't keeping pace. And that's even at 2.6% mortgage rates. If you look at our housing affordability index, even in the first quarter of 2021, when we were at basically rates, all-time lows for rates that my dad would have killed for back in the 80s, we had affordability deteriorating. So the growth in home prices was more than canceling out the benefit of the reduction in these rates. And so we were already at a scenario where 75% of households in California could not afford the median priced home. And that, is a huge concern, not just for us as real estate professionals, right? Obviously, we're going to do better when more people can afford to buy and own their own homes, right? Then we're going to do more transactions. But this is why, people outside of CAR need to really start getting serious about the housing supply issue, because if we can't deliver on the American dream, and we still see that's one of the most constant things that we've seen in our 30 years of doing survey research at CAR, is like home ownership still is synonymous with the American dream. When you ask people, do you believe in the American dream? They say yes. When you say, what does that mean? They say it means owning your own home. And do you want that? Yes. It's like overwhelming at 80% plus people think that way. And yet if we can't actually deliver on that, I think that is why you see people leaving California. If you look at the out-migration from California and you look at the destinations where people are going, they aren't these like phenomenal high quality of life type of places. It's not like everybody's moving to Aspen to ski and mountain bike, right? It's like they're moving to Phoenix, Arizona. They're moving to, Henderson County, or whatever, Clark County, Nevada, right? They're moving to Texas and places like that. They're moving to places where homes are affordable, where they can achieve the American dream, maybe even have a house with a pool, right? Like, yeah, it's 108 degrees, but guess what? My mortgage is $1,200 a month. So I just keep that AC cranked. I think that is the bigger challenge that we're up against, because we still have businesses here that need to recruit workers, right? We still have an economy that we want to grow. So yes, we care about this as realtors, right? Because we want to, help people buy and sell homes and get their foot on the property ladder. But, California isn't going to be able to continue to be the kind of top 5 states for economic growth if we're hemorrhaging, all of our middle class, our managers, all these amazing graduates that we train at our top-notch universities. If we're just training them to go work at businesses in Austin, Texas, then then that's a huge waste, in my opinion. And I think something that we're going to have to continue to grapple with, because those affordability numbers, I think, will get worse. And you'll continue to have this kind of split economy where these high income folks with parents who own property and with companies that gave them stock options and then went public and did all that stuff will continue to become homeowners. And then we'll have this kind of other class of folks who are just permanent renters and don't end up kind of ever, achieving that American dream. And that's sad.
Speaking of that, and I apologize, I'm kind of blanking right now, but I feel like it was Proposition 19. And I don't know if CAR had a position on that or they didn't have a position. I'm not looking for your position on it.
Yeah.
But have you seen that? And that was, does it not seem like the election was years ago and not just 7 months?
Right. It's crazy. Days are like weeks.
That was the transferring of your tax base
to a new property.
To the new property, and the heirs of a property having to reassess the property if they weren't going to personally live in it. I mean, in a real overarching view, is that a fair statement?
I think those are the two big components of it. And then there's like a big disaster relief portion as well. So if your house was burned down in one of these big wildfires, then you can move as well.
So with that happening, with people being able to transfer tax base, and with people having to maybe inherit homes and not just keep a rental home now with practically zero tax base, has it been long enough? Are we seeing the results shake out from that at all? Is that still a 2 or 3 year vision to see how it shakes up?
I think it's still going to take a while for us to fully realize, well, it's going to take a while for the data to catch up, right? So state reporting on how many people are actually invoking and being reassessed or transferring their property tax is going to be, many, many months, if not a year off, probably from when the BOE eventually puts those numbers out. We've been surveying on membership, and the kind of response that we're getting from folks on the ground is that they have clients who are considering invoking Prop 19 and maybe using their tax base, and that there could potentially be some new supply in the pipeline on that. And actually, we've had folks say that they've even had clients who have moved and intend to use Prop 19 to avoid that property tax increase. I think it's going to take a while to ramp up. And I also think that the big kind of missing component before we see a more market impact out there is that, we got to start building senior housing, right? And communities for these folks to move into, because, getting a good price for your home and not suffering the property tax penalty is one piece, but you've also got to have a home that you want to move to. And that's the other piece that I think it'll take a while for builders to respond, and therefore for a lot of those transfers to start playing themselves out.
How are new, the only stats that I hear about building starts are national.
Yeah.
So obviously California can't possibly be keeping up with some of those other states in building starts, or new home starts is what we call it. But how horrendous or average, I don't think it's above average. I think that one's just gone. So how bad or average is our new home starts right now?
Yeah, this is a delicate one for me to answer, because we're doing better, but I don't want to say that we're doing good. Okay. So if you look at permits through the first 6 months of 2021, I think we've permitted about 60-ish thousand units, maybe in some change, 62, 63,000 units. So that's about 30% higher than where we were at this time last year. But it also, if we keep up at this pace, means that we're on track to build about 120 or 130,000 units this year. And that's still 50,000 units shy of where we need to be just to tread water on housing affordability. And certainly, way short, probably half as much as what we need to be building to start, improving housing affordability and get to a scenario where incomes can actually keep up with the increase in home prices.
Yeah, so we almost got even.
We almost got
right now we're still a little in the deficit. Maybe if we're closer to being even, but we're still a little in the deficit. At least in that we're not at the bottom of the hole. All right.
Yeah, we're at the deep end of the pool, but our head's still about 7-8 inches below the surface, unfortunately.
Yeah, that's a good analogy. Loretta asked, this is an interesting one. Do you expect the water shortage crisis to continue to impact housing supply? First time I heard about this was yesterday. Like, we had an event at my house last night for somebody, and people were talking about everyone's at Costco now buying water again because of the housing shortage crisis. And it's actually an engagement party at our house. So we wrapped people in toilet paper, and we were talking about how last year we would have been millionaires.
Yeah,
if we could have wasted toilet paper like that, right? And so all of a sudden, I was looking at my bottles of water that everyone was drinking. I was like, hey, wait a minute.
You're sitting on a gold mine, Dan. Yeah, exactly. I think that the part that we're reading about on the news is transitory. There's all kinds of crazy supply chain disruptions and things like that. But I do know that water is an issue in California, and the provisioning of water is something that stifles residential construction. I think that we have water in California. It's a question of how we choose to use it and allocate it, right? We also, grow a lot of stuff that we ship off to the rest of the world, right? And we also have a housing affordability scenario. So I think there's also some prioritization that could be done and some efficiencies that we could get out of our existing water supplies. But I think, to me, the bigger thing holding back, that's not my top concern when it comes to falling behind on construction. Honestly, we've got crazy regulatory environment, right? We've got a kind of patchwork of different local regulations, depending on what city and county you live in. And we've got public perception problem, frankly, right? We know that we have housing affordability issues, but we think that putting new supply in our neighborhood means, falling home values and all kinds of traffic and crime and all that stuff. And so I think it's incumbent on us to figure out a way to get housing supply in a way that's palatable to a broader swath of the population and do a better job, frankly, of connecting the dots on what happens if we don't get serious on housing supply. Because again, we're not going to be able to, buy and sell the homes as realtors, right? We're not going to be able to get people into home ownership, but California is not going to be able to have this kind of economy that punches above its weight either if we don't have good people to put in these good jobs.
All right. Somebody asked, I didn't know if they missed it, and I think we didn't answer it just because it's not your guys' stats. I know you pull it from an outside source. Is there a number or is there a spot that they can go to see growth rent?
You can look at rent growth, and I think rents are up by single digits. I want to say we look at it on a market by market basis, so I don't have a good California statewide number the way that I do for a median home price. But I think we're looking at the kind of 5 to 7% with the last numbers that I saw for most markets outside of San Francisco. So, that's a year over year calculation. But when you look at the kind of shorter term trend, the numbers have been ramping up more quickly as the kind of market has normalized or the economy has kind of stabilized rather.
All right. Well, we're about to wrap up. Is there anything that you wanted to touch on that you planned on touching on? Since you guys don't know, I'd never rehearsed any of these calls. It always freaks my speakers out because they're like, are we going to do a prep call? And I'm like, no.
Yeah.
Like, I don't want to practice. I want to be surprised authentically. So we didn't do that, right? So is there anything you wanted to talk on or thought I'd ask that we didn't touch on real quick that you want to jump into?
No, I don't think so. I mean, we didn't talk about foreclosures, but I'm relatively optimistic there about, coming wave of foreclosures tanking the market. I'm not, I always kind of joke that I think there is some folks out there suffering from the brother-in-law effect, right? Or the Kool-Aid effect that, when prices are going good, people always think we're on the brink of 2008 all over again, but we had much different fundamentals coming into this crisis. It was an unprecedented shock. Absolutely. But it was one that was happening to what was otherwise a relatively healthy economy. And so I think that, it's important to kind of keep those broader fundamentals in mind because the news changes all the time. COVID numbers go up and down. We press pause on the economy. We open it back up. All this stuff is happening. But if you, if you kind of keep in mind where we were pre-crisis, we were relatively healthy economically. And I think that's an important point.
All right. Sir, thank you for taking time and being here today.
Dan, thank you so much for inviting me. That was a lot of fun.
That's fun, right? Yeah, it's fun having these conversations like this. So everybody, keep an eye on the Orange County Realtors calendar events. Go check out who's going to be doing something tomorrow, later in the week. Go check out when I'm going to be doing something next if I don't annoy you too much. Keep reading all the cool stuff that the CAR is putting out. They are there as in service of the members for the state of California and all of you as the realtor members of the association in the state. So keep reading all the stuff. Pay attention to what Jordan's putting out. It's all over the CAR. You can go to CAR site and see your forecasts and stuff, right?
Yep. CAR.org. We're in the industry 360 part. All kinds of goodies for you.
And keep getting educated, everybody. Be safe out there. Enjoy the rest of your August. If you're one of those people who are in Hawaii and Cabo, like it feels like 50% of the people I know are right now, not happy because I'm not there with you. And thank you very much. We will be back sometime next month. Have a good one, everybody.